back to JPX and market weekly updates. Crude futures Friday were in a sharp retreat as oil markets headed for a fourth straight week of losses, with stumbling economic growth seen hitting oil demand. The Middle East benchmark Dubai crude was slightly lower on the week and holds above Brent. November Brent and Dubai EFS was over $1 down on the week, trading around $4.65 on Friday's Asia close. However, the Dubai prompt market structure also weakened, with the first line and third line spread falling $1.30 on the week, while the one-year curve was down 75 cents. Crude market has struggled to recover from the midweek price slide after the U.S. Federal Reserve increased rates by 75 base points and flagged further hikes lasting to 2023 on Wednesday, followed by damaging economic news from Europe at the end of the week. Germany saw its composite PMI drop to 45.9 in September, while the Eurozone saw its PMI fall to 48.2, which is also the third decline in a row, indicating broad-based contracting business activity. Higher U.S. rates have also pushed the dollar to 20-year highs, weighing further on commodity prices. In the short term, oil prices were likely to remain weak as financial conditions tighten and demand outlook disappoint. Supply concerns have lent some price support, particularly as the EU embargo and price cap on Russian crude approaches, while Russia's mobilization of reservist troops likely means no diplomatic solution to the Ukraine crisis in the short term. Any Iranian deal is looking increasingly unlikely, as U.S. officials said Thursday that the efforts to revive the 2015 nuclear deal had hit the wall, while EU officials have warned the window for securing a nuclear deal is about to close. Markets were also keeping a cautious eye on Tropical Ian as it rumbled through the Caribbean on Sunday and the forecast tracked towards the state. Supply-side focus is expected to turn to OPEC's likely reaction to falling prices when it meets on October 5th, with some analysts expecting a further reduction in quotas unless there's a clear pickup in demand. On the oil product market, distillate prices in Asia have tumbled relative to Europe on news that China was ramping up export, increasing the likelihood of Asian volumes heading west. Chinese diesel export reached a 13-month high in August, according to the latest customer data. The 10 ppm diesel price in Singapore versus that in Europe sank to a 5-month low last week. It was back up at Tuesday's close, but still more than enough to cover freight costs between the two regions. Distillate supply has been tight globally and has become more acute since the war in Ukraine. Russia supplied over half of European middle distillate imports before the war, and soaring natural gas prices have diverted more gas oil into power generation while simultaneously increasing the cost of production tenfold. U.S. exporters stand to benefit from sanctions on Russian oil, as Europeans secure alternative supplies. Latest EIA data show that distillate export jumped by 25% to a 4-year high of 1.76 million barrels per day last week. Transatlantic spreads are likely to stay wide for some time, as Europe seeks to replace Russian oil producers after EU sanctions begin in February. U.S. producers also likely to maximize runs of distillates where possible to take advantage of firm margins, which are at least 3 times higher than gasoline. EIA data also show that distillate output reached an 11-week high of 5.24 million barrels per day. Fundamentals are the polar opposite in gasoline. Gasoline cracks waned in August, with excess supply building up all summer in Europe and the United States on below-average road fuel demand. Oversupply in Europe helped push the east and west spread narrowly positive in the first week of September for the first time since March. According to the latest Eurostock data, refinery output in EU 16 fell in August as declines in gasoline and naphtha outpaced higher middle distillate production. Unlike diesel, Russia provides very little gasoline directly to the European market, so supply shortfall should not be a problem next year. Another thing to note is shipping costs for crude VLCC on the eastern market have soared to post-pandemic highs. OPEC producers in the Middle East have been mainstay of output increases during 2022, while an anticipated rise in Chinese refining to take advantage of increased export quotas on refined products is also boosting demand. On the other hand, rising freight rates could also dent demand. Indian refiners are set to largely avoid purchases of Russian export crude this month for delivery in October and November as a result of soaring freight rates, turning to Africa and the Middle East instead. Okay, that's all for this week. For more information, please stay tuned to the JPX Energy Market Weekly Updates.